Strategies when investing in shares. There are generally two approaches or strategies when it comes to stock investing: passive investing, active investing. Passive investing is also known as the buy and hold strategy. You believe that the market is efficient and the easiest way to invest is simply buy a fund that tracks the index that represents the market or sector that you wish to be invested in. On the other hand, active investing involves a more hands-on approach. You believe that you can outperform the market by selecting growth stocks or value stocks, or choosing between cyclical versus defensive stocks. Passive investors believe that it is not possible to beat the market consistently or identify market inefficiencies regularly. They are then content to simply buy and hold. Most would then opt for exchange-traded funds, that is, funds that track particular indices. Passive investors believe that the market is efficient and so do not aim to outperform the market through active stock selection. Time in the market is more important than timing the market. The passive investor builds wealth gradually over the long term by staying invested and letting compound interest do the work. Most passive investors invest in equity index funds that simply track stock market indices. These can be in the form of unit trusts, which are unlisted, or index ETFs. Note that ETFs will have lower fees and expenses than unit trusts. Active investors believe the market is not efficient and that it is possible to make money by exploiting inefficiencies. This can be done by selecting stocks using tools like fundamental analysis, or by trying to identify themes which might be expected to outperform in the near to medium term, or even by trying to time the market, maybe by using technical analysis. Before you start crunching numbers, though, it's critical to develop an understanding of what the company does, its products and/or services, and the industry in which it operates. Active investors use fundamental analysis to derive a company's value. They plow through financial statements, look at the notes to the accounts, calculate the financial ratios, compare similar companies in the industry, look at economic forecasts and how they will impact the valuations. They also need to look at the non-financial information such as the quality of management, and by conducting SWOT, which is strengths, weaknesses, opportunities and threats analysis. Then they may use technical analysis to decide when to buy and sell. They look at charts and study the trends and use technical indicators. Technical analysis is not covered in fundamentals of share investing. Active strategy, security selection. When selecting stocks, there are two main investment styles: value investing, growth investing. Value investors look for undervalued companies whose share prices are trading below their intrinsic value. For example, those which trade at low price-earnings ratios or offer a high yield. Growth investors look for growth companies with above-average earnings growth potential. For example, small-cap and technology stocks. Active strategy, sector or theme selection. Cyclical industries tend to follow the economic cycle. They do well when the economy is doing well. Examples would be airlines, discretionary goods like home appliances, construction and luxury goods. Defensive industries are those which are needed in all phases of the business or economic cycle. Examples would be food, utilities and healthcare. ESG, environmental, social and governance investing, is growing in prominence. For example, investing in companies that are socially responsible and pursue green policies, gender equality and have strong corporate governance. In the next video, we will look at how to evaluate a company's corporate governance. This message is brought to you by Institute for Financial Literacy, a collaboration between Money Sense and Singapore Polytechnic International.